Hello, everybody. This is Toni Turner, and welcome to the Market Now on Friday, January 31st, right at the market's close. Well, traders kept bets today that the Federal Reserve will wait until June to reserve interest rate cuts after government data showed inflation by the U.S. Central Bank's targeted measure ticked up to 2.6% in December, as economists had expected. After the inflation report, traders of futures that settled to the Fed's policy rate priced in about a 70% chance that the short-term borrowing rate will be 4.25% or lower after the Fed's June meeting. Little changed from earlier in the day. Okay, now as we always do, we're going to look at three charts that could give us some insight into the week to come. And as we always do, first of all, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. Of course, you all know this is the exchange-traded fund that closely follows the benchmark S&P 500 index. Now, today, the SPY closed at $602.43. Just off his recent all-time closing high right here a few days ago, January 23rd, at $609.75. Now, if we look back to the first week in December, we know that the SPY has gone from basically walking up. Of course, we've had pullbacks here and there, but basically walking up its 20-day moving average for most of the time since November 2023. And we know that back here we had a new all-time closing high the first week in December at $607.81. Then it fell and moved below the 20-day moving average, the red line, the 50-day moving average, the green line. On December 18th, it rolled down there, down below the 50-day, down to $585.89, held that for a day. Then gapped down to on December 20th to $580.91, then rallied back up here. Look how that moving average held it down, rallied back up to the 20-day moving average to $601.34, couldn't get over that ceiling, then back down below the 50-day to the January 2nd low right here to 580. And I was hoping, as I've told you before, that would hold and act as support at some point if we needed it. Held there and then rallied back up to 600, then fell to the January, so that didn't hold right away. Fell down to the January 13th low down here to $575.35. Now, after touching that low, it rallied nicely back up to right up here to our new all-time closing high so far at $609.75. Now, after that, it fell. We've had quite a time here. It fell back down through the 50-day to the 20-day, and again rallied to where we are now at $602.30 and where are we? 43 cents. Now, what I want you to do here, though, that's kind of interesting, do something I was taught to do a long time ago. Sit back in your seat, sit way back in your seat, and now look at the chart. And you're going to look at the chart with different eyes. Now, I know I've marked it up here, but look how orderly. Look, I mean, it gapped down in August. We all know that. But then look how orderly the price pattern is. Small candles. Not a lot of gaps, a few here and there, but not many. Small candles, kind of walking along. You can almost hear the SPY humming or singing its favorite song, kind of like walking through a really beautiful park, right? Then when it fell down, and this was comments about cutting Fed rates, then when it fell down, look how onerous it got. Look at all the gaps here. Look how kind of disorderly this price pattern got, from gapping up, gapping down, gapping up, gapping down, closing, gapping at one price and down to that, and closing on the lows, then gapping up the next day. Look how disorderly this is, trying to get a little order in the last week, but not too great yet. So there's lots of gaps in this from the middle of December on here. And for me to feel more secure in this market It needs to become more orderly. That's how we make money without losing a lot, in my opinion, is with an orderly stock or an orderly market, whatever. And a lot of times if the market's disorderly, then stocks will be too. So, okay, so back to the facts here. What do we have? We have resistance here. I'm going to call it 610. We got resistance here, here, right along here. We got resistance here at 610. I'm going to call it 609, 610. We've got support down to the 50-day moving average, and it and the 20-day just below it, just inverse. They're both coming in at 500. Well, the 50 days coming in at 597.37, and the 200's coming in at 595.82. So anyway, we know that 595.67, there's all potential support from these moving averages here. Then we go down to the 581 level that we talked about, potential support there, and then down to that January low at 575. We've got the October low down at 568, and if we need it, and I hope we don't, we've got the 200-day moving average here, potential support at 561 and change. So, of course, next week, with all we've got going on here, and there's a lot going on in this world right now, everybody wants to know, can it break to new highs? And one would hope, but with all of this disorderliness, I just don't know. This pattern is telling me to be patient, and it's telling me to keep an eye on my protective stops, and that's what it's telling me right now. And don't forget, we're still in the middle of earnings season. The next chart today is a daily chart of the Invesco QQQ, symbol QQQ. Of course, as you know, this is the chart that the ETF that closely follows our NASDAQ 100, the top 100 non-financial stocks in the NASDAQ stock market, including large cap momentum stocks like NVIDIA, Meta, Alphabet, Tesla, that whole group, the Magnificent Seven. So today the Qs closed at $523.21. Just a few points below the all-time closing high back here on December 16th at $538.17. Now, since these August lows back here, and we all remember that, the Qs have rallied up from that, came down, but then basically walked up its 20-day moving average up to this high again back here in December at 538. And then, like the SPY, but the Qs are always more dramatic because they're tech stocks, it dropped dramatically on those comments about interest rates down to 509, and then down here, right down here to 509 to the 50-day moving average in a couple of days. Then rally up here to 530. Then down to the 50-day, and we had the intraday dip here down to 506, then rally and fall, rally, and then fell to the January low here at $499.70. I think we can call that 500 for our purposes. Then rally up to 533, and then gap down, talk about disorderly, gap down to 510, then rallied to today, and today it tried to go higher earlier, but later in the day the market sold off, actually on news of tariffs. So the S&P didn't fall quite as hard as the Qs intraday, but both indexes, both ETFs fell late this afternoon about 2:30 when they started talking about tariffs. So again, the Qs closed today at $523.21. Now, so if we look and say, where's our resistance here? And again, this is pretty much the same as the SPY. Now, the Qs are always more dramatic and volatile because it's a bunch of tech stocks. You know how that goes. So this is not quite as orderly walking up the 20-day as the SPY was, but it certainly is much more orderly moving up September, October, November, December, much more orderly pattern than we've had since December, with everything gapping up and gapping down all over the place. It's disorderly, it's disorganized. Some people don't know, traders don't know whether to fish or cut bait. So that's what I'm seeing here. So again, we're still in earnings season. Let's go into this a little bit first. I'm sorry. And by the way, you all, I know my microphone is echoey. I have a new microphone that I can't get to work. So we know the sound system is a problem, and we are working on it. So thank you. So let's call in here for nearby resistance up at 533, and then at the highs at 538. We've got potential support down here with the 50-day and 20-day coming in practically right together. So the 20 days at 518.74, the 50 days at 518.23. So we'll just call it 518 here. Potential support from these moving averages. Then we have more down here at 510, then more down here at 500 from the January lows, and so forth. Then we can look at the 200-day here at 482. Hopefully we don't need it. So again, we're still in earnings season. I wouldn't doubt that we would see, I suspect we'll see more volatility next week. So please be careful here. Again, mind your protective stops. Okay, a chart we haven't looked at in a long time. You can tell I'm feeling defensive here. Everybody's got to have water, right? We are looking at a daily chart of the Invesco Water Resources ETF, the PHO. Haven't looked at this in a while. I think utilities are starting to save themselves a little bit here. This isn't all utilities, but it's a good ETF. It's orderly, as you can see, reasonably speaking. It has 38 holdings in it. The top holdings are, some of the top holdings are Ecolab, Roper Technologies, Ferguson Enterprises, Xylem, and Waters Corporation. I'm sure you've heard of it. Now, today at the close, the PHO was trading at $68.39. And just below its 50-day moving average, which is coming in here just right on top of it at 68.44. So we'll have to see if it can get over it. Just below it is the 200-day moving average. And then because of that steep fall, the 20-day is inverted, and it's down here at 67.03. Now, if we back up and look at this chart a little bit, look on the left side with me, we can see that the PHO was coming in the beginning of July. The PHO was down here trading at about $63, $64. And by the way, usually these stocks don't trade in the exact same pattern. They don't follow the SPY or the Qs, certainly not the Qs necessarily, okay? So these water ETFs are a little bit different. And again, back to the fact everybody's got to have water. So. But I'm looking at this as something that could be viable, but I'm not going to trade less next week. I'm not going to do that or get into new trades if the market is totally volatile and unruly. I'm just not doing it. But anyway, let's get started. The beginning of July, the PHO was trading down here at 63.64. Then it rallied up here to 69, pulled back, then rallied up here to 70, then back down to the 50-day moving average down here, then rallied back up and retested this 70 line right here. The PHO likes to retest from what I've seen here. Then back down here to retest the 66 right here. So we've got that retest right there. Then rallies, then drops, then gaps up where we got rallies, drops, back down below the 50-day, then gaps up here and goes up to this high here at 72.50, then drops down to the 50-day and about 69 here, then retests up here at 72.50. So we're testing these highs now. Now, as it turns out, this is the all-time high. This 72.50 level is the all-time high for the PHO. Okay, it's gradually been going up through the years. It opened a while ago, but it's gradually been moving up through the years. It retests its high at $72.25, then fell in December and January, as you can see, down to the January low at 64.10. And, you know, everybody's putting money into tech stocks. Then they got surprised. So this rallied right back up here, almost straight up, and is now consolidating along the 200-day moving average. 50-day, yes, as we said, is coming down overhead. So it rallied straight up, now consolidating on the 200-day moving average. The 200-day, as I think I said, is coming in at $67.88, so we can call it 68. We talked about this 50-day coming in at 68.44, and the 20-day moving average coming in at about 67. So what I'm going to do here is, if in the coming week the market is behaving somewhat, because I'm not getting in if the market's very volatile, if the market's behaving reasonably well, and if the PHO can stay above the 20-day moving average, again coming in at 67.03, I may buy a small position of the PHO in my trading portfolio with a stop, and I'm putting my stop down here at 66.70. If and when the PHO goes up, starts moving higher, if and when it can move above 71.50, I didn't draw a very straight line there for you, did I? But if and when it can close this prior high back here, if and when it can climb up through these resistance lines and get up to about 71.50, I will add more to my portfolio, and I, of course, by then will have a trailing stop on it. So you may want to keep an eye on the PHO in the coming week. And now, please know that at ToniTurner.com, we've lowered the price on all of our online training programs to make them more accessible to everyone. So if you'd like to become a more profitable trader, now is a great time to check out my timeless training programs. We're going to talk today a bit about increase your profit trading ETFs, and of course ETFs is always what we look at in this program. Increase your profits trading ETFs shows you right down here. I thought I had it on this list. Okay, you'll see it on the list. Increase your profits trading ETFs shows you the whys and hows of trading ETFs. We'll talk about sector ETFs, talk about high and low volatility ETFs, commodity ETFs, and leveraged and inverse ETFs, among a group we'll talk about, and more. I'll also give you my two favorite setups for ETFs, targeting both short-term and long-term trades and how to trade them for the highest profits possible. Now, since ETFs are less volatile than stocks, and it's one reason I talk about them in this program, traded correctly, they can be one of the easiest and most profitable ways to trade. They really can. So our new low price for this program is only $127, and you'll receive special bonuses when you order, including 1 month of Metastock daily charts or Metastock real-time charts, which I use in this program for free. From our ever-popular 7 steps to successful trading, to how to swing trade successfully. A lot of traders love swing trading. Trade the trend to profits. How to read charts, great for novices and brush-ups. 3 winning setups, great for short-term traders. Bottom fish like a pro, and more. Find out how my online programs can help you earn more money quickly and easily. And once you purchase, you'll have unlimited access to learn at your own pace. So be sure to check them out by going to the link on this screen, or easier still, just click on the orange button below. Until next week, be careful out there. Keep green on your screen. I'm Toni Turner, and this is The Market Now.